Wall Street loves easy money, high fees, big fat bonuses, and shorting dying companies. That's the game. But every now and then, someone comes along who plays Wall Street better than Wall Street itself. This time it was Bill Hwang. He wasn't a billionaire hedge fund manager, he was a ghost. Invisible to regulators, yet powerful enough to move entire markets. This is the story of his hidden hedge fund, a firm that technically didn't exist, yet managed to borrow billions from Wall Street's biggest banks and blow up $20 billion in just 48 hours. A collapse so fast it proved on Wall Street, even the smartest get played by greed. Bill Hwang was a simple man. He drove a Hyundai, read his Bible every morning, and quietly traded from a small office in New York. But behind that quiet life was a man who, from a single office in New York, controlled more money than the giants of Wall Street themselves. Born in South Korea in 1964, Hwang came to the US with his pastor father and widowed mother, chasing the American dream. He hustled through sales jobs at brokerage firms, earned his MBA at Carnegie Mellon, and eventually landed a spot at Tiger Management, the legendary hedge fund run by Julian Robertson, the man who turned $8.8 million into $22 billion and mentored a new generation of elite traders known as the Tiger Cubs. Hwang wasn't born into finance, he clawed his way into it. Under Robertson, he learned to bet big, think bigger, and trust conviction over caution. He often said his faith gave him an edge, but on Wall Street, conviction and faith can look a lot like recklessness. When Tiger Management shut down, Hwang launched Tiger Asia Management, and it roared. He made aggressive bets on Asian markets, turning $1.2 billion into nearly $5 billion at its peak. But like many traders, success made him overconfident. In 2012, US regulators caught up with him on insider trading charges. Hwang eventually pleaded guilty, admitting he had traded on confidential information. He paid tens of millions in fines and was banned from managing other people's money. On Wall Street, that's usually a death sentence. But not for Bill Hwang. He found a loophole a way back into the game without technically breaking any rule. Instead of running a hedge fund, he created Archegos Capital Management, a family office. And that small legal detail changed everything. A family office is a private firm that manages the fortune of a single wealthy individual or family. No outside investors means no mandatory disclosures, no quarterly reports, and most importantly, no real oversight. In plain English, they don't have to answer to anyone. Not to investors, not even to the SEC. For billionaires, it's the perfect playground, total secrecy, total control. And for Bill Hwang, it became the ultimate weapon. Archegos didn't build its empire the normal way. Bill Hwang found a loophole, one of Wall Street's most dangerous tricks. It was called a total return swap. In simple terms, it let him bet on a stock without ever owning it. The bank bought the shares and held them on its books. Hwang just paid a small fee and collected all the profits or losses as if the stocks were his. His name never appeared anywhere, only the bank's names did. On paper, he owned nothing. In reality, he controlled everything. He made deals with nearly every major bank: Credit Suisse, Nomura, Morgan Stanley, Goldman Sachs, all hungry for the fees and blind to the risk. The banks carried the stocks Viacom, CBS, Discovery, Baidu, Tencent Music, while Hwang quietly pulled the strings from behind the curtain. It was financial rocket fuel. Because through swaps, he could hide his true positions. No SEC disclosures, no transparency. No one knew how massive his bets really were. And because these weren't direct stock purchases, the usual margin limits didn't apply. So Hwang kept stacking swaps one after another until a small fortune turned into something monstrous. Normally, when you buy stocks using borrowed money, called buying on margin, brokers have strict limits. For example, if you put in $1 million, they might let you borrow another $1 million, a 2 times leverage cap. But Hwang wasn't buying the stocks directly. He used total return swaps, which are contracts, not actual ownership. That means margin rules didn't apply because technically the banks owned the shares, not Hwang. So he could borrow way more, 5 times, 10 times, even 20 times, because the system didn't treat him like a regular investor. That loophole is what turned $10 billion into exposure worth $100 billion. Archegos exposed a truth the banks didn't want to face. Sometimes they don't see the whole picture until it's too late. To every bank, Bill Hwang looked like the perfect client. Quiet, wealthy, low profile. Each firm saw only its own slice of his portfolio, and on paper, that slice looked safe. Credit Suisse saw media stocks, Nomura saw Chinese tech, Morgan Stanley saw entertainment. Each believed Hwang was diversified, balanced, low risk. But in reality, they were all financing the same bets. The same handful of stocks, Viacom, CBS, Discovery, Baidu, and Tencent Music, used again and again as collateral. Each bank thought Archegos owned a piece of the puzzle, but together, he was the puzzle. Individually, his positions looked harmless. Collectively, they formed a $100 billion time bomb hiding in plain sight. How did the biggest banks miss it? Simple: greed. Archegos paid massive fees, and as long as the trades kept winning, no one asked questions. Every major bank kept feeding the machine, convinced they could cash out before it exploded. None of them realized the others were doing the exact same thing, financing the same stocks with the same collateral. That invisible web of leverage made the entire system fragile. If one stock fell hard enough, it could set off a chain reaction across every bank tied to him. And that's exactly what happened. It all came crashing down in March 2021. Viacom CBS tried to raise money with a new stock offering, and the market didn't like it. The stock tanked overnight. For most investors, that's a bad day. For Bill Hwang, it was the spark that blew up everything he'd built. Archegos was built on borrowed money, layer after layer of leverage. When those stocks dropped, the whole tower started to collapse. The banks wanted their money back. He didn't have it. That's what's called a margin call, when your bets fall so fast that lenders demand more cash to cover the losses. And if you can't pay, they start selling everything you own. Every major bank, Goldman Sachs, Morgan Stanley, Credit Suisse, Nomura, UBS, Deutsche Bank, all knew one brutal truth. If anyone started selling, the whole thing would collapse. But guess what? Goldman Sachs didn't wait. They saw the risk, said, "Screw it," and dumped their Archegos-linked stocks before anyone else could react. Morgan Stanley followed right after quietly unloading billions before the rest of Wall Street even realized what was happening. They got out early, barely taking a hit. But Credit Suisse and Nomura, they hesitated. They thought prices might bounce back. They didn't. By the time they started selling, the market was already on fire. Within 2 days, over $100 billion in market value vanished. Viacom CBS down more than 50%. Discovery crashed. Baidu and Tencent Music wiped out. It was a bloodbath, one invisible man's trade setting off a global chain reaction. Credit Suisse lost $5.5 billion. Nomura, $2.9 billion. Even Goldman and Morgan Stanley, the ones who moved first, took hits, just smaller ones. And all of this because of one guy running a family office nobody was even watching. One man, a handful of stocks, and the most powerful banks in the world tripping over each other to escape their own greed. When the dust settled, the empire of Bill Hwang was gone. Archegos had collapsed completely. Bill lost everything. Billions wiped out overnight. He wasn't just broke, he was personally bankrupt. The same banks that fueled his rise lost a combined $10 billion. Credit Suisse was hit hardest, its reputation shredded. Executives fired, investigations launched. It became one of the biggest trading disasters in modern history. And here's the irony. None of it was even illegal. There was no Ponzi scheme, no fake numbers, no stolen money, just leverage, secrecy, and good old-fashioned greed. Regulators didn't miss it. They just assumed someone else was watching, and no one was. One man quietly borrowed billions from half of Wall Street, and no one noticed. And that's the real story. Archegos wasn't just a collapse, it was a mirror. It showed how fragile modern finance really is. When money moves faster than oversight, when greed outruns common sense, all it takes is one invisible player to bring the house down. Because in the end, it's all part of the money game. Like this video and subscribe, and I'll show you the rest of what Wall Street buries.